There is something else that I think like the dream, right? I talk about these hockey stick moments in terms of like debt instruments and using Onchain to facilitate it. I mentioned this elsewhere recently, but I would really, really love it if we could somehow get into a position where we could say like, oh, hey, I have a bakery in Chicago and I'd like to establish some debt for that on chain, so that you could actually see that you were facilitating some real world goods, because there is a very potent argument to be made that like really all we're doing is we're just sloshing money around in the same pool by keeping it all on chain, right? It's just all in the service of markets and like chasing liquidity and like arbitrage or what have you.
All right, everyone, this is a message for my DGen listeners out there. If you are getting scalped paying expensive fees to perp dexes, I highly recommend that you check out Index Co-op's new leverage suite. Now, whenever it comes to leverage, do your own research. This is not financial advice. Don't bet more than you can lose, all that good stuff. But if you are going to lever up, you might as well not pay an arm and a leg for it. You can get leverage on BTC and ETH with built-in liquidation perfection, now available on Base, Mainnet, and Arbitrum. So click the link in the bottom of the show notes and head over and check them out today, and you'll hear more from them later in the program. Hey everyone, this episode is brought to you by Supra, the vertically integrated L1 for super dApps. They have a very cool new product coming out called Supra Containers. So head over to supra.com. That's supra.com/containers. So if you're building on an L1 and it feels a little bit crowded, or the complexity of L2 and L3s are getting you down, just head over to Supra. They'll get you sorted. Thank me later. Hey everyone, this episode is brought to you by Fuel Labs, who's launching Fuel Ignition, a new high-performance Ethereum L2 powered by the Fuel VM. Now you're going to be hearing all about Ignition later in the program, but for now, what you need to know is they are launching phase 2 of their points program. So click the link at the bottom of the show notes and head over, start experimenting, messing around on Fuel today. Thank me later.
All right, everyone. Welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer. The views expressed by my co-host today are their personal views, and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
All right, everyone. Welcome back to another episode of Bell Curve. Today, I am joined by Laurence Day, who doesn't have, I think, an official title yet at Wildcat, but maybe we can call you Chief Yapping Officer. How does that sound?
That works.
Yeah. And actually, I found you, I've been a longtime Twitter follower of yours, but I saw you tweeting about some of the features in Wildcat V2, which I'm excited to dig into you with about today. But I actually wanted to get a sense before we get into some of the specifics of Wildcat, which allows for fixed rate, borrow, lend, and undercollateralized lending, which has been this long sought after and talked about category within the DeFi lending space. Can you just give us a little bit of a sense of the history of lending in crypto? There's been a sort of an off-chain history of lending, these sort of lenders like the Genesises and the BlockFis and the Celsius of the world. And then there's been a long history of on-chain lending and how that has evolved over the years.
Okay, fair enough. Also, good to be here. Thanks very much for inviting me.
Thanks for hopping on.
I do think that ever since kind of the launch of Ethereum and the rise of smart contracts as something that you could kind of meaningfully use to basically put out whatever you wanted into, this possibility of doing lending in an undercollateralized way was always there and has happened on chain in several ways, as we've seen. And they've not all been failures. Some of them worked really well, and they still work. However, when it comes to DeFi in general and crypto, we've got this, don't trust, verify kind of slogan that we've really internalized, simply because we see the dangers of, getting drained, getting wrecked in various ways. The way that things collapsed has been like adequately illustrated by Sam Bankman-Fried and co. And so the lending that we see isn't typically lending, right? It's through platforms like Euler, it's through platforms like Aave, which are generally over collateralized. It's put in more than you can stand to lose by borrowing out, and so on and so forth. But that isn't really appealing for entities that want to say borrow size. So market makers, funds, anyone that really just kind of wants maybe more than like 5 figures. And so there was already facilitation for these kind of exchanges and instruments that were made available through entities such as Genesis, Celsius, Nexo, and so on, as you precisely mentioned, right? And they worked. And like credit always works until it doesn't, kind of contingent on whatever happens. the the way these generally always work and have done in perpetuity up until the current day is that that you'll have parties that will meet up, they'll make an arrangement together, it'll be dealt with completely off chain, and the only thing that actually happens on chain is the exchange of assets, right? And no one will know that this exists. No one will know the kind of what the terms are, because there's no trace of it on chain except for exchange of assets. And then it really just kind of waits until something goes wrong before we find out that these existed. We saw this with the collapse of Three Arrows Capital. I've mentioned this a few times in other places. That PDF that they threw up, going, here are our assets under you put whatever PDF, no further questions, Your Honor. And
Oh God.
just
You should get that framed, hang it in the Wildcat offices.
it's something that we've posted more than once as kind of like, this is why we're here, and other people have taken that lesson to heart too. Both in this cycle and previous ones. You see entities such as Maple, now moving on to Syrup as well, Clearpool, entities like Goldfinch, Centrifuge, even Aave with its credit delegation limits. They all work in like attempting to do the same thing, which is fundamentally allowing one party to borrow more than they stand to risk on chain. And these work, right? They did really well in terms of the amount of volume that they put through in the previous cycle, and I think it was very much just a case of once 3AC and FTX collapsed, that's just the ghost went out of everyone. No one was interested anymore, because there were a lot of bodies in the water that were friends of people that were VCs or relatively large players in the space, and even significant amounts of retail. We're still seeing the aftermath of that happening now, and these are all interesting, right? It's defaults happening in credit all the time. That's kind of where the risk premium comes from. That's why you do it. It's further out on the risk curve, but that doesn't make it bad. But crypto is always a funny thing, because it's so kind of tightly bound in with so few entities. I think that like the fates of one entity could do and demonstrably have had this really weird ripple effect and domino effect that takes out several others, like more so than any kind of like banking crisis that we'd have seen 16 years ago.
Completely. We were talking about this a little bit before we hopped on here, but the first season of Bell Curve, for folks who've been listening for a long time, was actually on fixed rate and undercollateralized borrow lend in crypto. And this has been an interest of mine for a long time because for a couple of reasons, which is one, it's just a new interesting part of the market. The TradFi analog, right, is there is asset-backed lending in TradFi, and then there's under-collateralized lending. That's changed over the years. Now you have all these like personal guarantees and stuff like that. But the market for under-collateralized lending is, I used to know the stats off the top of my head, but at least a full order of magnitude larger. Right, it's massive. And then the ability to borrow and lend at a fixed rate is also massive as well, because most of the like the Aaves of the world are great, and a lot of people use them for great reasons. But the variable lending rate on that is really tough, right? Because as a borrower, your yields can just spike. They try to fight this by providing liquidity through facilities like the D3M and stuff like that. But it's just very challenging, right? And it constrains you. And so on the one hand, this is a really large market that no one has quite cracked yet in crypto. But on the other hand, the other reason it's interesting from my vantage point to the overall space is that we've essentially only had equity financing in crypto to date. And it's two ways to finance yourself if you're an organization, through equity or through debt. And the market for debt is much larger for companies that size and at maturity. And so it's kind of this super interesting market on one hand, but it's also, it feels to me like because this market hasn't developed, it's holding back the growth of crypto in some way. Do you agree with that?
Yeah, no, I absolutely agree. I mean, to your first point, the variable rates curves that work on platforms like Aave work really well, kind of within a sealed environment, right? Assets in demand should charge more of a premium, but I think what you end up seeing is the way that like the kink works is that like towards like that last decile or quartile, you end up seeing like really kind of perverse incentives that pop up where people can be like, oh, well, we want to drive stuff down in terms of our capacity, or we may second hop some of the assets that we've borrowed and move it somewhere else to kind of reduce our the amount that we're after. Or perhaps, if it's something where they do have control, so like we're seeking to borrow way more than we actually want to keep ourselves fairly low down on the curve.
Mm.
And it's also really then tricky for someone who wants to lend, right? Because let's say that I go to you, Mike, and I say like I'm going to deposit to you into something that's an Aave,
Mm.
and I then go into a coma for a month, and it turns out that like right before I did that, you actually paid back a bunch of debt and drove me way down, like on the curve to where I wasn't expecting to be.
Mm.
I think it does work really well. Like I'm a long time user, a daily user of a bunch of these platforms, but in terms of the kind of assurances that you would want for, I'm lending you X money and I want it to be set at a certain rate for X and Y time, is just missing, right?
Yeah.
And as we were saying before we started recording, this is the same kind of this constraining of where debt kind of can grow, or like the fact that it doesn't grow in crypto is what happens to like original DAI. It was purely backed by Ether. You got DAI in exchange, but DAI could only really ever kind of cap out at a maximum amount, short of all of the Ether that was around getting popped into CDPs. And so I think this was recognized, and we started seeing multi-collateral DAI, and we started seeing other kind of assets that could back things up. But even that's not kind of fully there, and I don't think we should be having like fully widely accepted stable coins that are like completely under collateralized sitting on chain. But the invention of so many lending instruments centuries ago was really what sparked off these growth, these hockey stick moments in various industries, right? So again, I was commenting beforehand, like the reason that the British Empire managed to do all of the things that it did was because people were happy to lend them money in London to sod off and go do things in Sri Lanka or India or what have you. Pretty risky. I don't think we would have managed to do that in crypto now, but it was there, and it's generally always this kind of how do we finance debt? How do we like establish patterns of debt and kind of what are the recourses for that are hugely important. We keep talking about how what we'd like to do with crypto and DeFi is to rebuild the financial system. That's one
Yeah.
of the really common refrains, and you can't hope to do that without a couple of core things, and that's equity financing, as you've said, and debt financing is one of the others. Everything else that you build on that is very much the money Lego, but you're kind of tying one hand behind your back if you don't have a good couple of mechanisms, not just one. I'm not suggesting Wildcat's the only one. Ways of handling this stuff on chain.
I have so complete and just want to underscore again that sort of lesson of history. And I would recommend anyone who hasn't read Niall Ferguson's Ascent of Money. It is a really good read. And he starts with sort of the history of money as a precious metal, more commodity based money, the transition into debt instruments, credit based money, all the way up to equities and modern. He actually, I was reading it at the time. And I was like, this guy, I feel like he would like Bitcoin. And he has now since gone back and added a whole chapter on Bitcoin. So it's pretty cool. Yeah, it's pretty cool.
You said you were reading this around 2017, right? So Ethereum would have been fairly new. So that's when I got into it. So like, exactly. I don't think like the possibility was there. Hal Finney identified this in 2010. He was saying that he thought that, like the fate of Bitcoin was to end up kind of in like banks with against them, perhaps in under-collateralized ways, depending on the policies.
There's so much great content from that period of time. I joked that I'm entering my second Bitcoin arc. It's like all of the stuff that's happening right now. If you want to know what's coming in the discourse, just go back to the 2010, 2011
forums and just
they were talking about all this stuff back then. It's so funny.
Yeah.
So one more question to you before we get to, because I want to get into the weeds of Wildcat and how it's designed. I think it's very interesting that you bring up this idea of multi-collateral DAI, and there is a little bit of a sliding doors moment here, I think, because this was Maker's big challenge, is the scalability, because for the most part, people are going to Maker to get leverage on their ETH, and it turns out there's only a certain that market is only so large, right? And so if the idea is to continue to expand the DAI supply, you need to look for other forms of collateral, and we've gone down this RWA route, to I think success, but certainly some trade-offs. And I'm wondering from your standpoint, if we had figured out something like under-collateralized lending, do you think that some of these DeFi protocols would look different today? Do you think RWAs would be as big as they are? Like, how do you sort of play out that path dependence in your head?
I think things like T-bills and what have you that appear on chain are very much, the reason that like when we say RWA now, what we're generally referring to is like, 5 years ago, we used to be talking about, real estate.
Right.
And nowadays when we say it, it's really just a byword for T-bills. And I do think that that is almost a consequence of this need to kind of allow for exogenous kind of interest to appear from somewhere. And because undercollateralized financing wasn't really kind of, no one was simpatico with the idea at the time, or if they were, it was really early, or they felt like the technology wasn't ready, because that's what, an exogenous source of interest as well is just debt. But because the way that we'd structured, the way that we thought was that, okay, well, it has to come from somewhere, so it might as well be the US Treasury. And so this is why like Tether is such like a massive money printing machine, right? Is that everyone was kind of looking for this like collateral and source of yield, even though Tether keeps all of it because they're only obliged to pay the face value. I do think had we solved this a couple of years prior, I certainly don't think Tether would be as big as it is now. I certainly think we'd be looking more towards like RWA would be a lot more exotic. I think we're getting back towards more exotics. Every time you kind of like peek your head into what Germany and Switzerland are doing, they're always kind of going, yes, we're here we are like on our fifth or sixth attempt to tokenize stocks or what have you. And you're seeing this now as well with BlackRock's Biddle Fund. We're starting to see kind of like more collaterally like assets like appearing to back stuff up. I think Maker would have existed anyway. I think we're all lucky to have like a thing like Maker that exists. I don't want to posit, mostly because I don't want to be told that I'm incredibly wrong in my read of like how it would have looked had we not decided that it was things like USDT and USDC that were going to be added as backing as well. Like what if it had been something like debt financing for Maker itself or like a major investor? I think you could drive yourself mad that way.
Yeah, I think it's very tough to figure. It's kind of an unanswerable question. I'm just curious, and the reality is they're both critical building blocks, right? Like you need all of these things. You want, over collateralized lending with crypto native collateral, are like T-bills and dollars on chain, and then you need under collateralized as well. So. Yeah. Maybe with that, Laurence, we could get into Wildcat. Can you just start at 10,000 feet, give us an overview of what the protocol looks like?
Yeah, sure. It is fundamentally, just to use a sentence, it facilitates the settlement of fixed income markets. That's all it does, right? That's probably the 20,000 feet view. Going down a little bit further, it is very simply the way that under-collateralized lending tends to work on chain lately, or kind of in cycles gone, and the cycle that we're heading into is that a lender will decide to put their money into a pool where everyone else has done the same thing, and then parties that sit there as underwriters or credit risk analysts will decide. Borrowers will approach them and say, hey, I'm looking to borrow some money. And these underwriters will decide, okay, this is how much we reckon that you're eligible to borrow, and this is what we think that your rate should be. This works. It's also very kind of similar to the model that these off-chain entities, Genesis and so on, followed. It's just that the on-chain variant had a little bit more visibility because you could see at any given point kind of where things stood in terms of like how much was being loaned out, how much was actually available. What did the TAM look like roughly for people that were A, familiar with these protocols, and B, were willing to extend that capital.
Yeah.
The way we've kind of flipped this on its head over at Wildcat, where instead of having a single pool where assets get dumped into, where someone decides, this is where it routes to, we allow borrowers who have approached Wildcats and have passed some KYB. It's not an open protocol because otherwise some of the worst people in the world, like BitBoy, would create markets and say, hey, I'm looking to borrow $30 million.
That's who the US is thinking about when it comes to KYB.
It's very much the "Are you BitBoy? Yes, no." That's literally the only question they ask. Once you're onboarded with Wildcat, you effectively are allowed to deploy a market in any configuration that you'd like. And when I say any, I mean that there are enough dials on it that it does look a little bit like an airplane cockpit. So fundamentally, the asset that you want to borrow, because that's the most important one. I suspect for most people it's USDC or USDT or what have you. But you could borrow Curve LP tokens if you wanted to. You could borrow Milady. The fixed rate that you're willing to offer on it, how much of it you're willing to borrow. Now, this is the one where we are hands off. We don't perform any underwriting on this. And I will loop back to you by talking about Rari here in a second. Kind of what your withdrawal cycle period looks like, whether it's a fixed term market, so whether any funds that you dump in have to stay there for 6, 12, 18 months, and so on and so forth. The minimum deposit amount, how much of it, you can kind of self-select for the certain type of entity that you want to lend to you by saying, okay, only $250,000 at once, please. And beyond that, it really is a market, a credit line that is owned by the borrower, parameterized the way that they think is going to be like appealing to the market, or even if it's just that they want to have settlement on chain through private counterparties, and they're actually not seeking to borrow from the wider crypto space. It's owned by them, it's directed by them, it's parameterized by them. Wildcat's actually very hands off, and the reason that this is the case is that I said I'd loop back to Rory. I might as well do it now. We saw a recent SEC case against Rory Capital, and one of the things that they objected to was, you guys tried to to grade these pools in terms of risk by scaling them between A to F, and by doing that, you were performing an information service. You were effectively acting as a broker. So it seems that, funnily enough, the contra to trying to provide as much information that you can is very much let the market decide itself whether something is sane or not, whether it's risky. Now, there is more to that, because the fundamental protocol itself is very hands-off, but then there's obviously social aspects to it too, which I can address as we go forward. But, I mean, if you could think of it as Wildcat as facilitating on-chain bonds, you could think of it as facilitating under-collateralized lending. It works for a bunch of entities, a market maker that wants to facilitate thicker liquidity, a fund that thinks it's locked into some strategy that it just wants to use the capital for, and can offer an appealing rate for it, a DAO perhaps that wants operational funds and has a bunch of native tokens that they don't want to sell in order to facilitate that. So say you're Aave and you don't actually want to sell a bunch of Aave, you can go off the back of Avara, the entity itself, to go, like we clearly have the assets and we can clearly be compelled to make you whole if you wanted to, but save us a bit of time and effort here and we'll just borrow directly through Wildcat. I suspect that's going to be the case of quite a few DAOs, actually.
I actually want to spend a bunch of time on who this is for, the initial use cases that you see. And the market maker one is fascinating to me. The DAO one, I'm going to keep referring back to this season to pump my own tires. But that to me, like the DAO debt financing is protocol debt financing in general is extremely interesting as a use case, because I mean, you've just seen, I think DeFi 1.0 is a really interesting use case for this, maybe, or example of they have basically they did extremely well in DeFi summer, and they've been working through this supply overhang of their tokens ever since, and they haven't seen some of the appreciation that maybe their fundamentals would dictate because of these weird token supply dynamics. But I want to ask you actually a little bit, because it was interesting reading. First of all, by the way, do you write your white paper? I see a little bit of Laurence humor infused in it.
It's very much, if you can tell that there's a man who would be loves to do nothing more than sit in LaTeX writing white papers, it's probably got my grubby hands on it.
Yeah, I was like, all right, there's a little more personality than I'm used to in these white papers. So I would highly recommend it. It's worth a read. But one of the things that I was thinking to myself as I was reading it was, this feels a little bit different from the strategy that I've seen some like the compounds and the Aaves of the world coalesce around, which is, I feel like Aave in its earlier days used to be, you can create a market for any collateral. And they've since said, hey, you know what? People really just want to borrow USDC for the most part, or an ETH. And so we're going to specialize for those markets, be as capital as efficient as we want. And, we can get into some of the specifics around like the market maker use case that you've outlined in the white paper, but it almost feels like you're going in the opposite direction and saying, actually, this should be completely dictated by the borrower. We want it to be really customizable, which is great, but it also maybe fragments liquidity a little bit across different pools. Like, how do you view that trade-off?
I think that's probably a fair observation, and I suspect it's very possible, and probably more likely than not, that the majority of the volume that a Wildcat will see is just going to be it's going to be three categories. It's going to be stable coins, it's going to be ETH, and it's going to be Bitcoin. Right, that's it. I think fundamentally, the market structure, the way that the actual code works, is that it's completely ambivalent. It doesn't actually care what the underlying asset is.
Yeah.
So you may well find, if we come back to talk about this a year down the line, that there are, say 100 markets, but only about 8, 9 of them have significant volume because the rest are all just sitting there in LP tokens or assets
Yeah.
that like they could be in like in WorldCoin or something
Mm.
that people were perhaps interested in using temporarily for a fixed purpose, and just the appeal to byte just isn't there anymore.
Mm.
This is also very much just down to not wanting to impose. Like, I don't want to put our thumb on any kind of decision point about this, right?
Yeah.
I think when the idea first manifested, the first purpose I actually thought of was A, for market makers, and B, for DAOs. So like
Mm.
these are very much kind of two things that have run through the entire time. And as soon as you talk about DAOs, then you want to be talking about their native tokens as well.
Mm.
But one of the things that Wildcat doesn't do is it doesn't demand collateral up front from
Mm.
anyone, right? So you can attach auxiliary contracts that have collateral in them, so provided there's a path for them to be liquidated. So you could say, oh, I'm Aave, and I'll stick a contract on that has a bunch of Aave in it, but that's not collateral as Aave. What would happen is it would be liquidated into the asset that I'm seeking to borrow, so
Mm.
USDC, USDT. So so long as there's a path through an aggregator such as 1inch or CowSwap or what have you, that's possible. But you're not, if someone defaults, they're not getting liquidated and being sent Aave. That's also, I think, quite risky because you end up like it really depends on how thinly traded your collateral token is. Like
Yeah.
if your collateral is just Sol or wrapped Ether, then you're fine. But if it's something that like is fairly new, then you're probably going to get like 18, 90% like a slippage, like at the really high end, depending on what you're after. But yeah, I don't think you're wrong. I think stablecoins are what most people demand. But when it comes to people who are perhaps interested, like you have a couple of DAOs now that are even just not even just. It's actually a fairly complicated thing. It's like yield farming, kind of in 2024,
Yeah.
is a lot more perverse and long winded than it used to be a couple of years ago, where it was just dump into protocol and then go into a coma. And now you actually have to do quite a bit. And so there are a couple of intermediate assets that some people may actually want to have.
So, how would you expect if I put a gun to your head and made you guess, there's going to be a bunch of different vaults that spring up, I would imagine, when Wildcat launches or the new version launches. And would you expect that it's very diverse, or would you expect that a lot of the liquidity concentrates around a handful of like 3 pools, 5 pools? I mean, what do you expect the power law to be?
I do expect there to be a fairly high power law here. This is how these things always go. But
Yeah.
one thing that's worth noting is that, kind of as we settled in towards saying, Wildcat V2's code is finished and now we've just got some UX and legal stuff to do, people have been piling in and had been piling in even while we were developing, all from the thing of, I'm a one-man band.
Yeah.
All the way to kind of we're about to launch a DAO to we're a really small firm. We've maybe got like 5 million AUM, and they've all been interested. There's a couple of kind of like neobanky like entities as well that are looking for buffer capital if they have to swap between currencies on exchanges. But I think the most interesting thing was that I had received a bunch of messages from people who said, "This seems really cool. Is this going to be available for me as retail to create a market to borrow?" Because to pull one example out from like recent memory is like I'd really want to purchase a mortgage. I'm like, I think that's a really cool idea. I think if you could, that's exactly the kind of thing that I think we should be facilitating on chain. But it's so far out on the risk curve compared to say lending to like I don't know. I'm just going to mention like Jump
Yeah.
or something that like it's very easy to sue Jump in a default. It's much harder to sue Laurence Day, who then like promptly gets on a plane.
Yeah.
I think in terms of talking about the power law question, I think this is really tricky because one of the bugbears that I've had in my mind throughout is that the Wildcat V1 exists, right, and Wintermute use it in no small amount. But I do also feel that if 3 Hours Capital or Alameda Research had deployed a market on Wildcat, a bunch of people would have loaned to them sight unseen. Kind of just leveraging on the reputation from online. Like these masters of the universe, and of course we saw how those ended, right? So there is always kind of like what are you opening in terms of Pandora's box, and I'll loop back into kind of like the protections that can be offered, or kind of I think the level of awareness that you should have going into these things. But my point is that if you create a credit marketplace effectively, which is what Wildcat is seeking to be in terms of it is a bazaar where you can walk in and go, here is who is seeking your capital on what terms. I think if I walked into a room as someone who perhaps, I worked for a family office, or I hit it big on some shitcoin, and I really just want to just kind of lock something away like relatively safe. I suspect I would probably lend to large market makers, even above and beyond perhaps like smaller DAOs. That I don't know so much, right? And I think that's a social problem, but I also don't think that's a problem that's new to crypto. I think anyone would sooner lend to Boeing, even though they're literally blowing shit up in the sky, than they would to my bakery.
That's one of these human problems is really tough to get around. There are these problems in media too. It's the corollary for media is everyone complains that it's incendiary comment, it's not nuance, and it's like, well, guess what? It's like that for a reason. No one wants to consume nuanced content. The market size for confirmation bias is 2 orders of magnitude larger than the market for nuanced content.
Look at the Washington Post, right? Over the last 3 days, right?
It's been super interesting. I think I saw like a third of the editorial staff ended up leaving after that op-ed from
and
Bezos.
They've lost 10% of their subscribers.
Yeah. So
all the position of Jeff Bezos trying to exert a little bit of nuance, right? Many such cases.
No. Yeah. People don't actually want nuance. That's one of these like human engineering problems. It's like the cup holders in cars, right? What everyone says they want versus what they actually demonstrably, like empirically want, is super different.
If I see one more person on Twitter going, people would ask for faster horses, I think I'm going to send it post.
You bring up, it's an interesting point though on the under collateralized side, because look, I am a supporter of crypto. I'm a stand for all of these principles about transparency and permissionlessness and trustlessness whenever we can get it. But I do remember people saying, hey, when FTX was blowing up, DeFi is completely fine. And the reason that it's fine is because it's transparent and it's on chain. And I just wanted to poke at that a little bit because I'm not 100% convinced that was the reason. So for instance, by the way, Luna was totally transparent and on chain. Didn't stop anyone from doing dumb shit about it. And the other thing was first of all, I'm not the big difference for most of the big lending protocols is that it was over collateralized instead of under collateralized lending. Then the other thing is that for like the Maples of the world, by the way, huge fan of Maple, love those guys. But they were much smaller than the BlockFis of the world. And I think the reason why probably they made the decisions that they made was that they had to find new sources of yield. And at size, it's just, you have very limited options, right? So actually, in a weird way, Three Arrows had a ton of leverage. Like Alameda and Three Arrows had a lot of leverage over their lenders, which is why they all blew up.
Yeah. So I do fundamentally think that this is down to kind of crypto markets. Like, they could be as transparent as you want, but fundamentally, like, one of the most important things that you need in a market is liquidity, right? And so you do find that there is this pantheon of a couple of parties, to this day, where if one of them collapses, then you're going to start seeing like a bunch of the rest of them drinking hemlock as well. And all of a sudden, your 0.1% slippage on your stablecoin trade starts looking an order of magnitude higher, if not more.
Yeah.
And so you're right. There is significant leverage kind of available there. Like, if you're a market maker, if you're just a big fund, then that old adage of you owe a bank 1 million, it's your problem. If you owe a bank 100 million, it's a them problem. And I think that's exactly what happened with like 3AC and Alameda, because they were considered so pivotal to things. And as you say, right, like that leverage exists, and I don't think can necessarily be solved for. And one of the things that we, kind of the core thing running through Wildcat is like, if you're going to enter into this stuff, there's two sides to it. It's a discoverability problem, right? Mm-hmm. First off, you may have a borrower who is perfectly good at, actually very creditworthy, really interested in like making use of some capital, and they've actually got a good idea for it with contingency plans. But lenders don't know that they are looking for capital. Similarly, these borrowers may be like, oh, okay, well, time to rotate around a little bit because we don't know who's seeking to lend to us, or not to us, but to any one of our comps. So this also then becomes kind of a who party, right? Like, if you don't necessarily know like how to reach out to someone that's an OTC broker, or kind of have the an ear for like someone that works at an exchange, something, it's really hard to see kind of where these opportunities lay in order for you to extend credit, which is, I think, also why you found places like Celsius so successful, right? Because everyone was very happy to just listen to Alex Mashinsky and his promises of 8% yield at the time, which during the ZERP was a gangbusters amount of money compared to like what anywhere else. I think the way that we view it is that, sure, transparency doesn't necessarily mean much in terms of like preventing the aftershocks of things, but what it can do is it can serve as an early warning system. So what we found kind of previously was, these opaque entities kind of collapsed, and there were a bunch of them dead in the water, and that didn't reflect on chain for quite some time. And I take your point about Luna.
Yeah.
The skids for that were very much greased in a very visible way. But it also wasn't as if there weren't people that were ringing the bell about that like 6-9 months before. Like,
they were, yeah. 100%.
You can go back now and like if you see some of them, like there's posts that say like I think this is going to happen, and then loads of responses going Lisan al Gaib, like he called that.
Muad'Dib.
Muad'Dib is too humble to tell everyone he's going to liquidate everyone. That's why he's Muad'Dib.
Yeah.
I do think if you have the settlement layer of credit on chain, even though the actual agreements themselves are legal and they are signed between parties, you do have a degree of protection against rot, or at least advance notice that someone's pissed in the liquidity pool. If I default, for me and my grand total of what I have, like I'm running like a one-man prop shop. Yeah. The only people that are mad at me are like, a couple of my LPs and maybe anyone that extended me any credits, kind of, OTC. If Jump Crypto collapses, that's a huge problem for everyone. And then the question there is, all right, did they screw up, with one of their risk calculations, which is perfectly fine if that happens. Like if it's literally just someone like made a plan, like the super cycle thesis was wrong. And that's
shocker.
And that's almost okay, right? I think if it's more like, is there rot somewhere in this building, and we can expect to start seeing a couple more victims.
So look, I've got a question. I actually was planning on getting into the weeds with you about how this protocol actually works, and I'm just asking you these vague high level questions. But how do you think about the trade-off in between transparency and opacity when it comes to financial markets in general? And here's like a couple of examples that I would give you on this that I don't know how I feel about this, but on the one hand, you want transparency because when you were looking at something like, everyone loves to talk about the financial crisis and all these different derivative positions that were super opaque and no one understood the risk.
Yeah.
And what if that big
before that, everyone loved to talk about Enron.
Right. Yeah. Right. Yeah. Yeah. So, people love to, there was, I think, right, that big money market fund that broke the buck. And there was some really small percentage of Lehman paper that was in there, but no one knew how much it was. And it ended up being like 2% or something like that. But because it was so opaque, everyone just flooded out of it. Right. And they broke the peg to the dollar. So that is a challenge around opacity. On the other hand, I also, if you go back to one of the old financial crises, which was long-term capital management, right? They ran the goats, right? Yeah, the goats on risk who used a 5-year look back period to calculate all of their stuff, right? But the challenge that they had was actually, as soon as they ran at crazy leverage, right, like 99 to something that even today would never happen, and as soon as they got into trouble, there's a pretty famous story about Goldman. They brought Goldman in to try to look at their books and see if they could help them find some of their position. They basically passed those positions to traders to pick them off, right? And so, in some senses, actually, opacity can be a feature because you don't really want the entire market to know your positions because then they can push you around a little bit. And so, how do you think about the transparency?
I agree, right? I think one of the things that has been quite important to think about on my end, and I may lose my train of thought here because I want to visit about 3 stops on the way, is that one of the other things that we don't do is because we don't underwrite at Wildcat. I said you can create a market and you can ask for $1 billion if you wanted. You'd be like, yeah, we'll have a yard of circle, please. And if people are willing to fill that, then that's completely on you. Again, we have a template legal agreement that we will kind of impose on people. They can choose to provide their own or nothing, but I would very much suggest anyone that watches this that wants to learn about Wildcat only engage with markets that have a legal agreement in place. that the other side of things is like, how do you kind of price the credit risk, if at all, right? Or are you just kind of like punting in? So you saw how there are entities such as kind of Credora, who do God's work in terms of they'll take financial they'll take your financials and some other data about the assets that you hold, etc., and they will produce a credit risk report. They will try and like scale you like somewhere between Italy and Timbuktu, in terms of where you stand in terms of your probability of default. And I think the issue with that is that so like that scales to a certain extent, but you also end up having to trust these parties. That they do stuff in an SGX, or you like rely maybe on some more kind of zero knowledge based entities, such as Accountable has just been created. They're a new startup that I recommend you look at, that provide like dashboards of assets that are held. And so, the way this works is that you would, you'd give like read API keys for your exchanges, any assets that you have to sign messages that said that you control any on-chain wallets, any kind of bank reading, etc. And you want to be able to kind of provide that kind of information in a zero knowledge preserving way. So like, I have this much, but I'm not telling you where it is. To be like, okay, well, if someone's asking for $1 billion but they only have 20 million in assets, then maybe that's not reasonable. But I think the other reason that you really want this stuff to be privacy preserving is because otherwise, if you are a market maker, you are revealing a gigantic amount of alpha. Like you might as well just leak your entire strategy to be like, okay, like what exchanges are they on and what pairs are they on? Basically just gives the whole game away.
Yeah.
Right?
This is where I wanted to get to as well, about the ZK element of this, because I know that this whole industry has been excited about it for 5 years, and it's coming every year, next year for 5 years,
always
every year.
6 months away from commercial grade zero knowledge tech.
Always 6. Yeah, it's always going to be cheap enough, and the latency is going to be low enough where we can actually use this stuff. But it does seem like this is a huge fix, and the reason that this excites me too is because if I had one ideological driver, it'd be privacy. I consider myself a pretty non-ideological person, but I actually care about that. I think that's
He's just like me. Yeah.
Big good for society. But I also, I see these people saying, "Hey, we got to go lead with privacy." I'm like, "Hey, it's a bipartisan issue in the U.S. to not preserve privacy. No one's interested in that in Congress, right? Both sides, like the Dems probably less so, but neither one is sticking up for it." And even if you go back to the encryption wars back in, I think it was the late 90s, and pretty good privacy and all that stuff, what got people over the finish line was not some ideology to preserve privacy for the benefit of the citizens. It was companies saying, "Hey, there's a business case for this. Like we actually would like privacy as well." And that's what I see in the ZK element of a lending market, right? Where it's not like, "Hey, it would be great if all these transactions were private." Market makers are like, "No, actually, I really need it to be private." You know?
Yeah. So you do find that I think the way the way that I've kind of made peace with this myself is that if you've borrowed capital through a Wildcat market, it is effectively yours for the time being. Title passes to you, at least under the legal agreement that we provide the template for. So if you really wanted to obfuscate kind of where you're going, you could bridge it and move it around a little bit. Kind of like dump it into an exchange and like move it somewhere else. Now that kind of like breaks the spirit of things, because you would want to. I think the whole point of this is at least you're tracking the debt, and you kind of like, people have asked like, is it possible to constrain things to where they go? So like, oh, the only reason I want to borrow is so I can provide liquidity on GMX. Like that's actually really hard to do in code. And if you wanted to kind of make that a covenant in a legal agreement, that's actually really hard to enforce as well, because someone would be like, oh yeah, no, I just moved it like somewhere else for the time being. But no one's actually really going to chase like a condition of default on that. I think the ability to do things like, at least show what assets you have as collateral is a very good case for ZK, right? So not necessarily the where's it going or where are my positions, like that like what am I doing with the capital that I borrowed? Because what I'm finding, having spoken to people, is that there's an opposite approach as well, right? Which is that on the lender side, you may want to be able to kind of prove using zero knowledge who you are. So another thing that we are very kind of like hands off on is like, who are the people that should be allowed to lend to a particular borrower? And the answer to that is effectively whatever it is that the borrower is comfortable with. So I think in the very base instance, it's going to be, like, are they not sanctioned? Are they not like subject to a sanctions designation under the US, EU, UN, anything that's kind of like tracked by the Chainalysis list, anything that's on OFAC? But that could range all the way to, things like, do you have a Coinbase verification? Please send me the DNA of your spouse. You can kind of go like pretty far there. But ZK is really tricky in that, because any party that really cares about ZK or about having KYC like data of their things, like they often can't make reliance on place legal reliance on where the ZK info has come from, right?
Mm.
So if you do if you enter into an agreement with somewhere like SumSub or or Comply Cube or whatever, you generally have like an SLA with them where like some liability will lie in terms of um, where the fault lay if it turns out that someone's accidentally like allowed Lazarus through some KYC process. I think for ZK it's a lot harder, right? Because you may in some cases just effectively be hijacking the credentials from somewhere else, like saying, oh, hey, I'm proving to you that I've signed into some bank, which is only accessible to people of a certain wealth. Therefore, this person must be accredited
Yeah.
In whatever jurisdiction. And so the way I've thought about this is, if it's really important to someone that they obfuscate the movement of their capital, they probably should not be using Wildcat, right?
Yeah.
I think that's a perfectly fine trade-off to make. I think simultaneously though that if it's very much like you are fairly happy to be kind of monitored, even though you do always have that liberty to kind of like, if you wanted to bridge and obfuscate, fine, that doesn't get rid of your liability on chain and that you've signed. It just means that like people can't see where the money's gone. And I think some people will be very understanding of that. You'll find 2 or 3 people that aren't, but again, they have the option to not lend to you. But no, that's it. That's the train has come to the end of the station there.
Hey everyone, this episode is brought to you by Index Co-op and their new product, the Leverage Suite, which I highly recommend that you check out. Click the link in the bottom of the show notes. Now, disclaimer, whenever it comes to leverage, do your own research. This is not financial advice, all of that good stuff. Don't bet more than you can lose. But if you are going to lever up, you might as well not pay an arm and a leg and save a ton of money and use Index Co-op's Leverage Suite. So the way that they actually achieve these savings is pretty cool. They leverage the power of money Legos, DeFi, in this case, Uniswap and Aave. So the cost of carry for this trade is actually based on the funding rate of Aave as opposed to perp dexes, which tend to be much more variable and higher overall. Additionally, perp dexes will also charge you usually based on the entire open interest, so the leverage exposure that you have as opposed to just the amount of money that you put in, which is what Index Co-op is doing here. And the result of what you get is just an ERC20, which gives you something like 2x ETH. So if you want to lever up and you want to save money doing it, I highly recommend that you go check out the Index Co-op Leverage Suite. Very, very cool. Thank you very much, Index Co-op, for making this episode possible. Hey everyone, this episode is brought to you by Supra, the new blazing fast, vertically integrated L1, which helps you scale your dApp. If you are a builder, you're probably dealing with some combination of cost, complexity, and fragmentation of existing solutions. So if you're building over an ETH L2 land, everything's feeling a little bit fragmented at the moment. And if you're building in Solana, everything is fast and on one layer, but maybe you're limited in terms of what you can do with your AppSpace. So Supra is rolling out a new product called Supra Containers. So you can head over to supra.com/containers. To learn more. They offer dedicated customizable app spaces running on Supra's 500,000 TPS Layer 1 blockchain. That gives you complete control over gas tokens and fees. So some cool things you can do, you get the freedom you can use your own token, create local fee markets, or even go gasless, whatever you want. So this product isn't live yet, but because you are a faithful listener of Bell Curve, you get notified first. So head over to supra.com/containers. Thank me later. Hey everyone, this episode is brought to you by Fuel Labs, who's unveiling their new high-performance Ethereum L2 Fuel Ignition. Many of you know Fuel as the launcher of the first optimistic Stage 2 rollup on Ethereum with Fuel V1, and now they're launching Ignition to address some of the creeping centralization concerns around some L2 architectures today. And if you like nerding out about the tech, there's a lot of reasons to get excited about Ignition, including how they solve state sustainability and performance execution. They have this UTXO asset-centric architecture that's very, very cool. But there's a lot of other reasons to love it. Super easy to use. You can either use a Fuelet wallet or your existing Ethereum or Solana-based wallet like Phantom or MetaMask or whatever it is. There are cool apps that you can experiment with. And again, like I said at the top of the program, they're launching phase 2 of their points program. So click the link at the bottom of the show notes, head over, start having fun on Fuel Ignition today, and just tell them that I sent you. Okay, I've got 2 questions for you on some of the trade-offs actually around, all right, so I really like, on the one hand, this idea of you're just matching borrowers with lenders and letting the borrowers dictate a lot of the terms. And you're, in one sense, eliminating a lot of kind of administrative overhead, I would guess, for Wildcat, the protocol. And in theory, you should be able to cut like willing market participants, free market, you should be able to come to better rates in terms.
Yep.
Additionally, the two questions that I have for you on this is, one, it feels like there's some additional onus that's placed on the borrower, and I'm curious about how you thought about that friction. Like, it seems like even like the KYB or KYC process from their standpoint is run by the borrower. So I guess I'm curious how you think about the trade-offs of the administrative overhead that Wildcat, the protocol, takes on versus what you're asking the borrower to do. And
Yep.
then I forgot the second part of my
You'll
question.
remember it as soon as I'm answering this one.
All right, yeah, perfect. So let's start with that.
I think the way I've envisaged this with the team is that we can't pretend to account, for every single set of permutations for the borrower.
Yep.
And if we did and started saying, these are like the buckets that you can lend in, it may be that we end up falling into kind of like broker or advisory providing services, right? Which again is not where you want to be. I think the one thing that we certainly will not do is like, we will certainly say like, oh, this market exists, this is the capacity, this is the rate that's for it. What we will not do is tilt over into, you guys should deposit into X, because then you're kind of like straddling both sides of the divide. In terms of the extra onus, I think any kind of sufficiently large entity will have a compliance desk, or they'll have like a legal like general counsel. And you're right. Like, I think it's a decision that needs to be made once in an entity about kind of where do we settle on the KYC question.
Right.
I do think that a very common one that we will see is just that, provided that a legal agreement is signed, that the only request that we have is just that you're not OFAC sanctioned, right? Because that's fine. Really, like that is an acceptable minimal bar. You don't necessarily need to have the passport of someone hashed and sent over to you in order to enter into an agreement. The way that we've handled this in the protocol itself is that no personal data of any lender is stored on chain, but someone who wants to countersign a legal agreement will they'll ECDSA hash it. And so, like, I'm the owner of this address, and that's worth it for them to then be like, this is a binding document that I can take around, right? So, again, like the bulk of the risk on this always falls on the lender. Of course it does. Like, who else could it possibly fall on? Whereas Wildcat itself doesn't have any kind of AML KYC obligations, except to like making sure that the borrowers that are deploying markets on it are actually they're excellent entities, they're legitimate, they're not Lazarus. Or they're not from kind of any of the other myriad countries like Cuba or Iran or what have you. But we don't want to say beyond that like, this is what your policy must be. What we can certainly do is say like, here are some ideas for the paths that you could choose, provided that your counsel is comfortable with them, and like effectively provide templates. And so these templates can then be cloned and deployed on chain as well. But I do think that even regulated entities, assuming that they all pour in, may find that they're actually just fine with making sure that sanctions are the thing that are dealt with, as opposed to perhaps having to enter into an agreement with, say, SumSub, and have kind of a ping to legal every time going, like from an API that says, okay, yeah, this address has just passed like a successful check, which may also be enough and is also possible to do.
Yeah. Okay, last question for you on this, and then I want to move to, we haven't really talked about some of the initial use cases that you see, and I want to end the episode talking about those. But how would you, one of the, like, on the one hand, I see the value in letting borrowers and lenders just come to an agreement in terms of what makes sense for them.
Yep.
I am curious how you think about, like, there are many instances of, what I'm thinking about right now is Aave in the Curve situation, where that at one time looked like a quite safe market. It was very over collateralized. You had the founder himself that was involved, but no market is really safe if the value of the collateral plunges 80% in a very short period of time, and it was risky for the whole protocol. And so, how do you think about allowing the free market to kind of come to their own terms versus protecting the brand or safety or whatever of Wildcat, the protocol?
I think what's that quote? We are selling to willing market participants at the current fair price, right? Um,
Jeremy Irons, but margin call. That movie has held up so well
it
over
really,
time.
really has. I do
Yeah,
occasionally
it's so
watch it
good.
again every year or so.
Yeah.
Um, I do think it is inevitable that there will be a default on Wildcat. I think that there is no point in pretending otherwise, because again, like, it is very much it's for free market participants, and again, it's very much the difference of the scale of that is down to like, A, who is it that defaulted, and B, like, why did they default? Um, I think it's more a thing, but like I try really hard to kind of just treat everyone as a rational participant in a market. That you're like, if I'm lending to someone that is doing high frequency trading, I should perhaps expect that at the event of a black swan, I will not be as protected as I want to be.
Yeah.
Now that may jar, I think, with the idea of um, kind of like protection that exists. But I also do think that like people are sane enough, kind of on the whole, especially if a market's configured with say like a particularly large minimum deposit limit, to effectively bar these people out. That kind of like may just be making stupid decisions. It's again like, and it always feels like a cop out answer to say things like I don't feel like I should be the one making this decision, because as soon as I do, we're in the mix.
I understand that. It's not a cop out answer, honestly. It's just I'm curious how you guys think about it. All
Yeah,
right,
yeah.
I want to talk about the use cases here. And you've outlined a couple of very interesting examples. One is market makers, and I want to start with the market maker use case, and then I want to end on the DAO use case. And
Yep.
so could you just describe a little bit about how you envision market makers being like a good fit for this protocol?
I mean, I think this is like it's almost fairly self-evident, right? The reason that market makers kind of exist and they make profit is because they're managing to uh, win to mute is just like the good example here, right? The thicker their liquidity, the more capital they have to offer, the better their bids and asks can be. Like the smaller their spreads, for what have you. I think one of the things that I'd always thought about when we were first designing it was that if you were a party that really wanted to market make for a new asset like WorldCoin, I think, had just come out when we released V1, or like Arbitrum or what have you. Your options really were to like borrow some capital, in USD or whatever, swap it somehow on chain or enter into an OTC deal to get this token, hope that you would be able to market make enough of it to like cover like the amount that you were willing to offer, as well as any kind of negative price impacts, because these tokens tend to be quite down, when you
Mhm.
launch them, and then convert back into stables and return them. This is one of the reasons why I fundamentally think that actually the the things that you would see being borrowed are just things like stables and wrapped Ether and wrapped Bitcoin, where there actually is like kind of existing liquidity that's like really thick, and perhaps it's just a market maker that wants to that reckons that they've got a better handle of it than anything else, because like
Mm.
better liquidity just generally makes for a smoother market, right? It's WD-40 on the wheels. Um, of course, then you end up with a situation where you may like elevate one to being like in a critical position, and then, as you pointed out earlier, you have a party that has like insane leverage over the market.
Right.
But again, I'd imagine that you end up in a situation where people kind of would hopefully ring sufficient bells, especially if there are things like Telegram bot integrations that can track how much is being loaned, where they're going to. That maybe someone will finally listen to one of the doomsayers and be like, "Yeah, you've given these guys $3 billion. Like, maybe you shouldn't do that."
Well, you know what I like a lot about what it seems like your philosophy is, picking up on the Wildcat white paper, is you want to bring this stuff on chain where it's more visible, all else equal. And this is something that you see, I think, in a lot of protocols that have especially constrained environments, is that you end up just moving a lot of stuff off chain, right?
Yep.
And so there's a larger meta conversation that we could have right now about like Ethereum versus other high TPS chains and whatnot. But I've noticed that this trade-off is the more constrained you make like the execution environment, the more you encourage people to just do stuff off chain in general. And so I really like that aspect of the Wildcat protocol. About some of this stuff is just human issues that we're going to have to deal with. The lending markets are always a little bit tough, but I completely agree with you that bringing stuff on chain is better than having it off chain. Did you, when you were thinking about this use case, because this is so far away from my world, but I hear these things about like these OTC deals and market makers, providing spreads on different coins that may or may not rip. And did you kind of look at that market and you were like, hey, first of all, this might be a good market to attack, and a lot of it's happening off chain? Was that the sort of genesis, or did you
It
start
was
from?
it was a Genesis idea that I'd observed,
Yeah.
and so this was one of the reasons why Wildcat like permits any asset to be borrowed. This was thinking that, let's take an example, right? Someone goes, hey, I want to borrow, like if you guys lend us like X% of your token and we'll market make for it if it goes onto an exchange, then at the end of like a year or so, whenever the maturity is, then like we may have like a strike on it where we can actually just agree to buy it off you instead. And one of the very first prototype examples of Wildcat, which was the one that I'd written myself before my co-founder Dylan Keller looks at it and said, absolutely not, and threw it in the bin because my code is rubbish. That was kind of what we'd thought about doing. Like it would basically be a facilitation for these kind of like OTC deals that you could because normally you would see like every time a token launched, you would see like a huge bulk of tokens move from like a foundation address over to some wallet that was like hitherto unknown, and everyone on crypto Twitter would just immediately wail and gnash their teeth. She'd be like, "Oh, what's happened? Well, what's going on? Oh, yeah, like the TWAP engine's been turned on again." Oh, what have you? That is something that I think has fallen out of favor now. That kind of deal. But I will also confess that I do not have an eye into the kind of inner machinations of like what it looks like now to market make a token like PopCat. I have no idea.
I have no idea.
Mainly because I don't have any PopCat, so I haven't bothered to look into it.
Yeah, neither.
But yeah, you take my point. I think that was something that's, having spoken to people such as Evgeny at Wintermute, that like I did say, like, is this something that appeals to you? And they're like, yeah, maybe like notionally, like, or a little bit, but I think like the wider like desire is for things like stablecoins or what have you. I think if you wanted to come back and kind of deploy a market for what I envisaged it to be, like you just want to borrow Milady for whatever reason, then you're still capable of doing that. That's not a problem. The only constraint is that the token that you borrow can't be rebasing. Just because that screws up the internal math, but that is a point that like no actual user cares about. And if a borrower is like, oh yeah, we'd like to borrow staked ETH, we'll be like, can you do wrapped staked ETH instead? And they'll be like, okay, fine, no difference to us, right?
Yeah.
That's kind of the extent of it. I'm not saying we do the we close two eyes thing, because we don't. Like, I'm very interested in like what people are interested in using the funds for. But you do see that like it's kind of a mix of like we just want more liquidity for XYZ, or it's something like we've established some kind of like fixed rates arbitrage strategy as a fund. So someone wants to do the yen carry trade back when the yen carry trade actually worked. That's possible as well with V2, but that's the kind of like thing that I would envisage a fund making use of, something like this for. Or just because they reckon they found some kind of hyper-powered DeFi strategy and they're just looking for some capital because they can execute it, but everyone else can't, either because they haven't got enough infra or what have you. Even like really on the kind of exotic tail of things, I think I've even thought about, what would it be like if someone like an MEV solver or an MEV searcher or like an intent solver wanted a bunch of capital as well for like private inventory, because they knew that they had this like gang busting like solver algorithm and they could go into CowSwap and just absolutely clear the field against like Wintermute's resolver. Like that's something as well that I'd be like really excited to look into, or like not like, well, facilitate if that's possible.
Yeah.
Now, before we jump into DAOs though, there is something else that I think like the dream, right? I talk about these hockey stick moments in terms of like debt instruments and using Onchain to facilitate it. I mentioned this elsewhere recently, but I would really, really love it if we could somehow get into a position where we could say like, oh, hey, I have a bakery in Chicago and I'd like to establish some debt for that on-chain. So that you could actually see that you were facilitating some real world goods, because there is a very potent argument to be made that like really all we're doing is we're just sloshing money around in the same pool by keeping it all on chain, right? It's just all in the service of markets and like chasing liquidity and like arbitrage or what have you. As soon as you can kind of bridge that off into something like Centrifuge do this, as do others, right? Like they explicitly lend to entities that are doing real world stuff. And I think maybe a bakery in Chicago is probably a bad idea, but I think you take the point, like something in, I don't know, Stockholm.
Yeah, completely. And there's a great, if you just look up the amount of, all right, here's a big area of the lending market in the US that I think is open, is that banks just don't lend to small businesses anymore. And actually the reason is why there's there's been massive consolidation around commercial banks in the US.
Yeah.
You can go look at charts going from the 1930s and 40s, and it's like a one-way ticket down. And if you talk to someone in banking, what they'll tell you is that's good because banks go bad and then they get absorbed. Their balance sheet gets absorbed into bigger, healthier banks. Okay, I understand that from a managing the financial infrastructure of a country standpoint. But what that means is that there's a hole left. There's a gap in the market for lending to smaller businesses that are meaningful to smaller lenders. And
It's,
just as Blockworks was bootstrapped for 5 years, man, I'm so familiar with this pain point. There's just no credit available. It's
yeah.
crazy.
Like
Yeah.
I'd love to see something like, the next Blockworks that appears and is like, we're looking for bootstrap capital.
Yeah.
Perhaps our fixed duration is like a very long amount of time, or, like one of the things that we handle in our agreements is that, like, someone may be insolvent by taking on the debt, but it only actually becomes a condition of default if the lender agrees that it is.
Yeah.
And I think anyone that's willing to kind of bootstrap that kind of thing says, you know what, this is fair. Like, we are like trying to watch someone create something. This long tail of kind of like underserved customers. You really see, like, I studied quite a lot. I'd worked on a credit startup before in about like 2020 using AI ML networks before you could raise $50 million for just saying all of those words together. And you saw this in the history of things like Grameen banks, and this kind of like social, like kind of like community credits that existed in places like Bangladesh and India. That, like, it is actually quite profitable to serve the long tail, because that risk for credit, and this is a line that I use in the white paper, is like that demand for credit is generally elastic in the face of real interest rates, but it's always there, right? Like, even if you're at the tippy end of like that underserved curve because everyone else is being served by like some massive conglomerates, that's still there and they're still creditworthy. I think the reason that they're not served is because of the power law, and like, where like 80% of your profits come from 20% of your effort, but also just because it just doesn't scale, right? It's actually exactly the same reason, right? Like, serving or handling like 150, 200 like
Exactly.
entities doesn't get you
Yeah.
nearly as much as like handling one branch of like one massive bank.
Totally.
And so I think there is potentially the opportunity for something like Wildcat, or like a competitor, or something in the vein, to facilitate some of this, because like a huge amount of the administrative efforts is alleviated by putting it all on chain. Again, you do similarly have these like legal agreements that you could chase someone down to, but of course, depending on like jurisdictional things, you may get like no luck.
Yeah.
But
It's
that's the game you play, right?
there's you can see that there's market demand for this, but another market that you could look at is this explosion in private credit.
Mhm.
And again, you can kind of see these forces lining up, and
Yep.
it's they don't like big banks or GSIBs or whatever taking on a lot of risk. And so a lot of the lending that banks used to do, it's the power law that you were mentioning in terms of the 80-20, the kind of Pareto of effort, but it's also, this is viewed as more risky in terms of lending. Regulators don't want banks to do it, banks don't want to do it. And so there are all these things that are lining up. And also the other thing about banks, man, is that the UX, the pain of going through the process that these people is immense. I've talked about on the podcast for you, I hate interfacing with our bank. I hate it. We finally switch. I have these stories that I could tell you about JP Morgan.
Next hour of content is just
Yeah,
this.
This is now a 2-hour like hate podcast of just rage about the banking relationship that I had. But yeah, it just feels like one of those areas that is really ripe for disruption. So
Yeah.
here's to hoping that Wildcat does find a way to fund or
I mean,
facilitate.
I'd love to. I've had this seed planted in my mind many years ago that well, five. I'd always been kind of interested beyond that, kind of reading like Debt the First 5,000 Years and so on. But there's kind of, we need more open credit access networks. But I'd never really placed it in the context of something like, oh, it's about serving the long tail, or it's about making things easier. I worked in a bank for 4.5 years in risk reporting, so I got a real look behind the curtain, even though like this was just more on kind of like the national bond scale side of things. That like these entities cannot serve. They both like won't do it for risk reasons, like because of like Basel or what have you, or because it's not worth the effort for them. And then this is where Grameen banks pop up. And I think the consequence of like a Grameen or a community bank is that, if everyone's really like co-located really closely,
Hmm.
that these things generally kind of devolve into mobster like tactics
Mm.
quite quickly. It ends up
Yep.
like veering into usury like very fast,
Mm.
which is kind of a tragic but altogether too predictable consequence of like community credit kind of in like small ecosystems where trust is such a fundamental part of things. um, I think, and I realize this may just be ideological cope, that kind of bringing some of this stuff on chain where there's a disintermediation of location between people that are lending, may help alleviate some of this.
Yeah.
I may well be proven dramatically wrong, and
Mm.
in which case, then fair enough. I took my like hardest swing of the bat at it because
Hey, that's all you can
one.
do.
That's true. One of the things that I've been saying is, like I said, like all of these extant under-collateralized and secured lending systems on crypto, they work.
Hmm.
For their purposes, there are people using them, so they clearly are like filling the purpose. But in terms of a truly kind of abstracted version that can scale, if not this, then what?
Hmm.
I maybe this is just a lack of creativity on my end, but like the way I kind of envisaged it was like if Wildcat's not the solution, then I don't see how this gets solved.
Mm. Well, cheers to hoping that it is, my man. Cheers. All right, I want to end on talking about DAOs here, and walk me through the use case that you see for DAOs and Wildcat.
Sure. So invariably, like I think this all depends on the type of DAO that you're dealing with, right?
Yep.
So if you are a entity that has, so you always see this, right? A DAO is newly created, and they have a bunch of their native tokens sitting in a treasury, often governed by Governor Bravo or something of the sort, which then becomes like a real pain to like dissipate or sell. Anyone that is kind of like initially like present or has a bunch of the unlocked token will create a liquidity market or like a uni pool or something of the sort, and that's generally quite thin because what they're doing is they're hoping to profit off of LP fees from like kind of really early bursts of interest. If you don't then like subsequently have something like a market maker agreement with Binance or whoever, which I think is like often quite a toxic apple that a bunch of protocols take because they feel that they need that to survive. Like they need the attention, they need the liquidity for their token, but they do have nominally, at least, kind of based on the Uniswap like pool, if one exists, or anything that exists on chain, quite a lot of wealth that sits in the treasury. Now, a bunch of a bunch of analyses generally tend to mark these down to zero when they look at the wealth of a treasury, and I think that's probably fair.
Mm.
But I do also think that there's a lot to be said for saying, okay, well, if the alternative to just taking these tokens and just like trying to run uh, a Governor Bravo vote to sell a bunch of it in order to do things like grant programs, because inevitably you see things like this, right? Grant programs get spun up, and like they'll pay people in the native token, or like contributors to a protocol will often like they'll sit there with vested tokens, or whatever. And some people, for whatever reason, may just want fiat,
Mm.
or because you have something like you need to spin up like some banking rails, or you need to pay some vendors. You need fiat, or you need like stable coins or something. And often some of these DAOs don't have them. Like it's just not there for whatever reason.
Right.
Often through the fault of anyone's own. It's just DAOs can often be quite insular, and I think in a very like self-protecting way, where they go, well, we don't want to sell the token that's in our treasury into the liquidity pool because then I can't exit. Which I think can often be quite self-defeating if like the reason that you want to like sell some of this stuff is to do something that actually makes things worth a lot more in the long run. But I think you often find that people will just kind of look like 6 inches in front of their face about like what does the exit like look like for me right now.
Totally. And it's so I really don't appreciate this attitude because it's really short-sighted. I mean, the whole point of what you're trying to do in these protocols is value creation. And the question isn't, hey, should I sell or not sell my token into the markets? What am I getting for that sale?
Yeah,
Can I use the capital that I get from that sale to produce more value for the DAO that will offset whatever the
yeah.
supply is going out into the market? It's a super simple
You inevitably
calculation.
find some true blue believers who will genuinely engage with this, and like Wildcat may end up a DAO in the future.
Mm.
I truly hope it does. And I think the nature of that, the nature of what it is very much like you would imagine that people take it quite seriously because like if it's aiming to be like a settlement layer for credit, then people will like take it for what it is. But in terms of like, so let's say that I am, I don't know, Burn, not yearn, burn. And I am I'm a new DAO, and I just want $1 or $2 million. I think it's very feasible and possible to effectively just like kind of have a DAO say, um, we'll establish as we'll empower some address to act as a borrower, kind of on behalf of this DAO, either through a foundation or just through some kind of like legal entity that's set up in its name. This is becoming easier to do. The one thing that we do right now is that, and this is something that we can't subvert, is that a borrower does have to have a legal entity in order to engage with Wildcat, because something needs to be the counterparty of a legal agreement. So like a true DAO would really struggle with this. But you could see like, some kind of corp being spun up elsewhere. It doesn't cost a huge amount to do. And allow a DAO, or party acting on behalf of a DAO, with some covenants that I'm not just like cutting and running with it to go, yeah, hey, we're looking to borrow 2 million USDC or what have you. I think you may end up in a situation like, kind of over and above. You say, okay, yeah, we'll dump a bunch of a token into a collateral contract attached to it, but we're not fundamentally selling it. I think that's exciting, but as I said at the start, I think that also really just depends on what it is the DAO is trying to do, right? If it's Aave, then like it's a revenue moneymaker, so they're going to be good for it. If it's like Rugby DAO, then you're like, maybe not. Like that really kind of depends on what it is that you're doing.
Totally. I think this was one of the challenges that I was thinking about even when we created this season on this whole topic, because on the one hand, it's pretty easy to look at the challenge of like equity financing is much more expensive than debt financing, right?
Yes.
So all else being equal, when you're looking at your mix, you should take that into account. And
Yep.
so only having this very expensive capital raising option is less than ideal. But what you need, like that doesn't make sense oftentimes for very early stage startups that don't
Yep.
have predictable cash flows. And so
Yep.
I think one of the challenges in general for this has been, where are we in the market, or just the life cycle of most of these protocols. But now is different even from 2 years ago, because if you look at the earnings of something like Aave or Maker or whoever, I mean, there are protocols that this makes a lot of sense for.
Yeah. I would really like to see Wildcat Labs dog food Wildcat itself.
That would be awesome. Huge fan of the dog fooding. Yeah.
Here's a Wildcat market for Wildcat Labs.
Yeah.
We'll see how this goes for us.
Yeah. That's awesome, man. I hope that.
I mean, I suspect we may do, even if it's just kind of like for a notional amount, just so we can say that we did it, and then like scale as needed, because we get to adjust the capacity of how much it is that we're seeking to borrow. I've had another really, really like good idea that's come through to me, which I'd really like to help with. People are generally not philanthropic as a rule. Obviously people are, and it's really heartwarming when you see. But one particular case that's been pitched to me a couple of times now through various entities is the idea of donating the yield. So you end up with something like, I don't know, Giveth or something like. Giveth has not reached out, but like I'm just naming them as an example of like a charity or what have you, where you could envisage something like an entity like that creating a market that is 0% APR. So you're not making any profit off of it, but the party that does receive the funds can then put it into Aave or something else, and then the yield from that can be used for charitable purposes. So you still have you still have a legal right to like the face value of whatever you put in, because that's not going to change. Like ETH, USDC, whatever. You may end up like incurring a weird tax. No, I don't think you would incur a weird tax event if it's a lending thing. Then you could imagine being able to generate like kind of shuffle out 5-6 figures of yield every year on something that just like goes to good causes. I'd love to see that happen. So like, for example, anyone watching this, if that's the kind of thing that you'd like to facilitate, please get in touch.
You know what? That honestly, Laurence, you've already been super generous with your time. Maybe this is a good time to start winding it down. And word has it that you are speaking on your birthday at DEF CON. So
I am indeed.
My condolences there.
Although with that said, this is the I will not be talking about Wildcat, because DEF CON does not have a doesn't have a DeFi track, and I try to adhere to kind of that ethos of like, don't make it promotional.
Yeah.
ETH Denver has this as well, where they say like don't directly shill stuff. So I went up to Denver in February this year, and I gave like a kind of really nuanced talk about kind of like why we need under-collateralized credit.
Yeah.
And, without I mentioned Wildcat like 2 or 3 times, but without like showing it. And then I sat down and watched 2 people just be like, "Here's my protocol. You should use it." And I was like, "What?" I didn't realize it was an option. So my DevCon talk will be a talk entitled "How to Destroy a Network," which is the kind of some thought experiments on what would need to happen to offboard the institutions. I think this is something like, does Biddle need to fail? Does there need to be a failure in Lido? Do we need to start seeing like Tether like get OFAC sanctions? In which case, like everyone just needs to put their cards away and go home.
Yeah.
But then like there's also some other kind of interesting ideological questions there, such as, if we cede too much kind of demand, like, or interest to the institutions like BlackRock and so on and so forth, does Ethereum change from what it was meant to be simply by virtue of the fact that like a bunch of these entities suddenly have a bunch of like POS Ethereum and can exert control over the network? So it's not going to be a talk about credit, although I will be there for the rest of the week talking BD and what have you. So if you're interested in Wildcat, please approach me. Just on my birthday, I will either be talking or I will be drunk.
That is a very fair state of being, and
possibly both at the same time. I cannot predict how that day is going to go.
Yeah, I saw that there's a West Ham party. This whole podcast, actually, the ulterior motive was just to get an invite to that party. So,
you now have an invitation to the West Ham party.
Let's go. Locked it in, baby.
That was actually really heartwarming. We'd said like, we can just fund it ourselves because events are quite cheap to do in Thailand by comparison. We did one in Denver that ran us 12,000 US. And so we budgeted about the same for this. And like we could have covered that ourselves, but we thought, there are a couple of brands and entities which we consider aligned with West Ham to the degree that, oh God, that's an insufferable sentence to say. But like, we like them, they like us, and so on. And yeah, within an hour, we met that goal like pretty quickly, which is nice. So
so great.
We still don't know West the venue.
Okay. That's the details. Those are details.
Detail is fine.
Awesome. Well, this has been a ton of fun, and anyone listening out there who's going to be at DevCon, definitely go chat with Laurence. But also, if folks want to find out more about Wildcat, the protocol that won't have the ability to see you in person, they want to follow you on Twitter or learn more about potentially being a borrower lender once the protocol goes live. Like, what's the best way to do that?
Yeah, so the Wildcat site itself is wildcat.finance. That's a really easy one. Wildcat Labs is available on Twitter at wildcatfi, wildcatfi. Beyond that, I am Function Zero on Twitter. Both of the O's are zeros because I'm an insufferable man. And and I think that's it. Like, I often talk about kind of my thoughts about Wildcat and under-collateralized lending when I'm not posting like someone with rabies. Wildcat itself is a lot more kind of, this is the progress of the protocol, and so on and so forth. But again, chat to me in the DMs, hunt me down on Telegram if you wish. You're not getting that one so easily. And just ask me whatever you want. My time is yours, anyone that has any questions.
Excellent. Well, Laurence, thank you so much for coming on the podcast, man. Congrats again, and good luck on the launch when that happens. And we'll have to have you back on sometime soon.
Brilliant. Thank you very much. Cheers, everyone.
All right. Cheers.